The last few years as an active manager has been more about what you don't own than what you do own. And if you're not in some of these names, it's similar to an emerging markets manager.
You're saying that's why active managers have underperformed.
They've suffered,
right? Because they've missed.
they can't make sense out of certain names that are going up, 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 and they get overvalued by their traditional measures of what value is. So then they end up trailing because they're not in those names. And similar to an emerging markets manager that maybe couldn't find positive reasons to invest in China, it was hard to not be in China, right? So it's almost more of a risk not to own some of this, no matter what your style is.
Liz, you make a great point. Now I'm thinking about Warren Buffett and this purchase, which is an evolutionary purchase, but in his portfolio, he has the old school value stocks that he doesn't rely on the multiples anymore, right? So he's got Burlington Northern. He doesn't care what multiple the market puts on it because he's just reaping the cash flow. Or Lubrizol, or NetJets, or any of these old school companies where he doesn't have to worry about the valuation. So, I mean, while we're talking about this evolution of the value investor, let's not say that we're completely departing from the foundation of looking at cash flows and trying to put a valuation on it. That's what I do.
It's somewhat of a morphing. And again, you know, Buffett can have the stocks that he participates in more personally, okay? And then the two portfolio managers, they're the ones who are his disciples. They're the new age value investors, if you will, who have a different, not ability, but an interest in these sorts of names. Buffett never would have. Buffett's not wasting. Maybe he's not into looking at the top to bottom of Amazon, but these other folks.
Of course, he's called himself an idiot in the past for not owning this, so he is evolving with this as well. I realize it's the other managers, but he's not exactly.
Well, you could say
on the
it's de facto Buffett, right? I mean, if they didn't think that if this stock was so far out of left field for a Berkshire portfolio, they probably wouldn't buy it. But this is the new Berkshire Hathaway.
If you look at the portfolio,
more open mind for companies like this.
If you look at the portfolio that Ted Wexler and Todd Combs have put together, and I think they started with $1 billion each, and now maybe it's $3 billion each, or maybe it's even more. But if you look at the commonalities between some of the bigger positions they've put on, and Apple is a good example of this, by the way. They like businesses with recurring revenue streams and with moats. And so MasterCard was one of the first names that Berkshire started to buy when Ted and Todd started to get some allocation. This is a business that's making money in your sleep. And they've got a moat, and they're not taking credit risk, and they're just getting these interchange fees on every
What's next?
toll booth.
Is Facebook
But
next?
Apple is very much like that. So when you think about Apple being 20% services and that services business growing and growing, they're basically collecting a toll. So now think about Amazon collecting a toll on a huge percentage of the sales of everything from cloud services to candy bars and groceries, and soon to be who knows what else, possibly healthcare. They like these toll booth businesses. I agree with Jim. I don't think it's a massive departure from what Berkshire has done with their publicly traded stock portfolio. I think it's an evolution, more of a revolution.